5 steps to investing in the share market for profit. Number 1, learn how the stock market works. To be honest, Hollywood has portrayed the stock market in a very inaccurate light. The popular perception is that stock markets are teeming with Jordan Belforts from The Wolf of Wall Street, each with a massive Scrooge McDuck pile of riches to swim in. The market is portrayed as the ultimate theme park ride, where entire fortunes are made and lost in split seconds. Sure, there are ups and downs in the market, and you can lose a lot of money if you make a bad decision. But most investors stick to long-term, boring, and safe investing strategies. They make these bets because they understand how stock markets work. Let's start with the fundamentals. A stock market is a place where people buy and sell investments, most commonly stocks, shares of ownerships in a publicly traded company. There are several different stock markets around the world, the most well-known of which are the S&P 500 and the Dow Jones, and each of which indexes the performance of a specific segment of the stock market. The fundamental idea behind stocks is straightforward. Stock exchanges allow you to purchase stock in a company. Investors purchase these shares, which raises funds for the company to expand and profitably grow the business. As the company's value rises, so does the value of individual stocks. Based on market performance, investors can buy and then sell their shares. The goal is to make a profit by buying and selling stocks. Here's an easy example. Assume company A begins selling stock at $10 per share. As more people buy shares, the company earns more money, which it uses to improve its performance. After a year, the total value of the company may have increased, and each share may now be worth $15. If you bought 100 shares at $10 each, your total investment would be $1,500, a $500 profit. The best part is that when you didn't have to do anything to get this profit, you simply had to invest, sit back, and watch your investments grow. Stock markets have historically been physical marketplaces, though they now mostly operate electronically via the internet. Stockbrokers are companies and individuals who help people buy and sell individual stocks. Number 2, define your tolerance for risk and set your goal. What is your risk tolerance? Stocks are classified into large capitalization stocks, small cap stocks, aggressive growth stocks, and value stocks. They all have varying degrees of danger. After determining your risk tolerance, you can focus your investment efforts on stocks that complement it. You should also establish your investment objectives. An online broker such as Charles Schwab or Fidelity will ask you about your investment goals and the level of risk you're willing to take when you open a brokerage account. If you're just starting out in your career, one of your investment objectives could be to increase the amount of money in your account. If you're getting older, you might want to generate income while also growing and protecting your wealth. Your investment objectives could include purchasing a home, funding your retirement, or saving for college. Goals may shift over time. Just make sure to define and review them on a regular basis so you can stay focused on achieving them. Number 3, select companies. Identifying companies is the next step in the stock picking process. There are 3 simple ways to do it. 1, look for exchange-traded funds or ETFs that track the performance of the industry you're interested in and investigate the stocks they're investing in. It's as simple as looking up Industry X ETF. The top holdings of the fund will be disclosed on the official ETF page. 2, employ a screener to narrow down stocks based on specific criteria such as sector and industry. Screeners provide users with additional features such as the ability to sort companies by market capitalization, dividend, yield, and other important investment metrics. Finally, look for news and commentary on companies in the investment space you've chosen in the blogosphere, stock analyst articles, and financial news releases. Remember to be skeptical of everything you read and to consider both sides of an argument. Number 4, fund your investment. All investments require an initial financial investment. It is a truism that you cannot create something from nothing, so if you want to make money in the stock market, you must first put money in. There are several approaches to investing that you can take. You could go it alone and create your own investment portfolio on an online stock brokerage, micromanaging all of your investments. Most online brokerage require a minimum investment to get started. If you don't feel comfortable managing your assets on your own, you can hire a financial advisor to assist you. Financial advisors manage all of your investments based on how your objectives and typically charge a percentage of dividends as compensation. There is also the newer option of robo-advising. A robo-advisor is a computer program that manages your money for you. Robo-advisors use sophisticated algorithms based on cutting-edge economic science to buy and sell stocks in accordance with your preferences. Number 5, learn to diversify and reduce risk. Diversification is a critical investment concept to grasp. In a nutshell, by investing in a variety of assets or diversifying, you reduce the risk that the performance of one investment will significantly reduce the return on your overall investment portfolio. Consider it financial jargon for not putting all your eggs in one basket. When investing in individual stocks, it can be difficult to diversify if your budget is limited. For example, you might only be able to invest in 1 or 2 companies with $1,000. This increases the risk. This is where mutual funds and ETFs can come in handy. Both types of funds typically hold a diverse portfolio of stocks and other investments. As a result, they are a more diversified option than a single stock.